Okay, morning everyone. So today let me just finish this chapter and just quickly go through some of the important material in the next chapter. And by the way, so those whatever we are going to talk about today is kind of review, and the new material will not be covered in the final. All right. And so in the second half of today's class, we will talk a little bit more about the exam, right? So we are in the chapter understanding money, banking, and then monetary policies. So what we have learned so far, or what do we have learned from this chapter? Basically, so we learn what is money, right? So let me just go quickly through these slides. So we learn money essentially is a financial assets that can easily be used to purchase goods and service. And you need to remember, so the money has three functions to serve, right? So including the medium exchange, including the store value, and including a unit of account. Make sure you understand what those means, right? And we also talk about the money supply. Okay, so what is money supply? Let's go to that slides. So money supply essentially, okay, so depending on how we define, so there are M1 and M2. So money M1 essentially is currency in circulation plus checkable bank deposit. And then the M2 is a broader definition of money supply. It includes M1, so that's here, and also include saving deposit. So essentially that's less liquid, right? So because checkable bank deposit, there's the money you put in the bank and you can withdraw anytime. But what is saving deposit? It's just you need to withdraw, but maybe you need to give a notice to the bank, right? All right. So this is money supply. Now the next things we discussed in that chapter is how bank or how the financial system can create money supply, right? And a particular bank, like banking system. How does the banking system create money? And from understanding how does banking system create money, we also should understand there's some risk or there's some fragility in our banking system that justify why we need a central bank to regulate the banking system. But first, let's just quickly review how banking system creates money. So let's just go to that example. So in that example, we start with someone who has cash, okay? And so without a bank, so this individual is going to keep the cash. And then the money supply will equal to the cash this person have. So in the first stage, that is before we have a modern banking system. Now in the second stage, so we have a bank, or we have a banking system in our economy. And then, so what is going to happen is, so this individual, Silas, is going to deposit money in the bank, right? And then, so actually for this individual, for Silas itself, so he has no currency in circulation, okay? But then, so this is going to 1,000 terms into $1,000 of bank deposit. But the bank, this is like a modern bank. So the bank is going to use this deposit or some of the deposit to make new loans. All right, so these new loans will be 900. But from here, so you should realize there's a reserve ratio. But then, so we are going to explain why there's a reserve ratio later, or like review why there's a reserve ratio later. Okay, so this $900 will come out of this 1,000, and this $900 will be lent to someone, and whoever took loan from the bank, so can withdraw the cash. Now, suddenly you're going to see additional $900 appears in the economy, right? And plus the $1,000 deposit that belongs to Silas. So you can see the bank creates money supply of 1,900. But if you look this very carefully, so you're going to see, so actually in the economy, we only have $1,000 of cash. And the 900 cash has been withdrawn by Maya, who took a loan from the bank. And the bank has $100 of reserve. Okay, and this reserve just used for emergency in case sellers need withdraw cash from the bank. And the reason why the bank can do that is because most of the time we don't need our cash. Or think of other way, so there are many sellers, like millions of sellers, put deposit in the bank. Yes, a particular seller may need to withdraw 1,000 or 100% of the deposit, but not necessarily all sellers or million sellers we have in this fictional economy, they will come to the door, right? So that's why the bank can lend out 900 and only keep 100 just in emergency. But certainly you can see, so if one seller among these medium sellers smell something fishy of the bank, and then so these sellers is going to spread rumor or spread the word to other sellers in the economy. And if this rumor keep going, and then suddenly you're going to see millions of sellers will come to the door of the buying bank and want to withdraw, and then so the bank is going to be in trouble, right? Okay, from this discussion, we should understand how banking system create money, and also we should realize what is the problem of this financial market or the banking system, right? The other things I want to emphasize is, so the bank lend out 900 to Maya. And the reason why the bank want to do that is in the hope so they can make some profit, right? But then, so this project can be risky, but usually the riskier the project, the higher the return, right? But then if the project becomes too risky, and it could be the case, so this business went sour, and the bank doesn't have money to pay or to satisfy the need of the depositors. So that also justify the regulation we mentioned earlier, and I'm going to review just in a second. So why the central bank requires the owner of the bank put some of their own money in the business. So why the central bank want them to do that? So that the owner of the bank, they becomes prudent or becomes cautious, not invest in some very fishy and very risky business, right? So let's just back to the regulation. Okay, so we talk about, yeah, by the way, so this is how things are gonna go, right? Just think about this like millions. In this background picture, there are millions of depositors, okay? And in the normal time, only a fraction of them may need the cash. So that just means for all the deposit, so the bank attract from those millions of savers, the bank are safe to lend out a big chunk of the deposit to make profit, right? But however, so in some uncertain time, so one of them so may find out so the bank is not in good shape, and then they start to spread rumors, and then you can see suddenly all of them just come to the bank, want to withdraw the cash, and the bank is going to run in trouble. So this is what we call the bank run. Okay, so this is a phenomenon in which many of a bank's depositors trying to withdraw their fund because they fear a bank failures. Right? So avoid these things happens, and then so there are certain regulations happens in the United States and in most modern economy. So this includes deposit insurance, just in case if indeed the bank fails, the depositors they are guaranteed, okay, with this insurance. Actually, so this deposit insurance can prevent the rumor to spread in the first place. Just think about you deposited 100,000 in the bank, right? Even though your neighbor told you, so this bank is going to have some trouble, you are not scared. You will sleep well during the night. You won't go to the bank immediately. Why? Because you know, so your deposit has been insured by FDIC. Even though this local bank did bankrupt, okay, but then so you can get your money through FDIC. So in that sense, you can prevent the rumor to spread in the first place. So this is the first bank regulation. The other bank regulation is called capital requirement. So just give the owner of the bank some incentive to watch the business they're going to invest, right? to avoid unnecessary risk taking. Right? The third regulation is called reserve requirement. So essentially, this is the amount, the deposit the bank must leave aside just in case their depositors need their cash. And then lastly, this is a discount window, which is an arrangement in which Federal Reserve can lend money to the bank that are in trouble. Right? So those are the 4 bank regulations. Now, the last things we talk about in that chapter is how the central bank can affect money supply. So what we just talked about is how financial market, or particular banking system, can generate money. Right? So that is given the currency in circulation, given the amount of currency in circulation, how the bank can generate this part. Right? But then, so we need to understand. So where does the currency in circulation coming from, right? Okay, so now let's just go to the central bank. How the central bank can generate money supply. So let's jump to that slide, and we can summarize what we've learned. Okay, so the central bank create money supply largely through open market operation. So here how it is. Oh, sorry, go these slides. Okay, so if the Fed want to increase money supply in our economy, what the Fed they can do, they're going to buy Treasury bill. So essentially, this is an IOU issued by Treasury Department. So by buying Treasury bill, the Fed literally pay for Treasury bill they purchased, and then the resource or the flow, cash flow, will go to the commercial bank, whoever sold the Treasury bill to Fed. All right. So now, as an outcome, so the Fed is going to increase the reserve of the seller. Okay, and then the sellers of the Treasury bill, they are going to have excess reserve or additional reserve in central bank. But then, so as we learned earlier, no bank has incentive to keep excess reserve. So they always want to use those reserve to make new loans so that they can make more profit. So that immediately means, so by selling Treasury bill to the Fed, the commercial bank will have additional reserve. And then so with this additional reserve, they are able to make new loans. And by making new loans, and then we are going to see their money generating process will kick in, as we just explained. On the other hand, if the Fed, they sell Treasury bill, and then whoever buys the Treasury bill, they must pay with their reserve in the central bank. And now, so they have reduced, or they have fewer reserve. And then, so their ability to make loans will be hampered. So they're going to reduce their loan. Now you can see, so this money supply or money generating process we just reviewed is going to downsize. Now you're going to see the money supply in the economy will reduce. Right? So this is how the Fed changed the money supply in our economy. Right? But actually, so in theory, the Fed has other 2 tools to use. So this includes, let's go back to that slide, and then we kind of finish this chapter. So besides open market operation, as we just reviewed, the Fed, they can also use other tools, right? So include, so they can, this goes here. So they can change the discount rate, which is the rate the Fed charge on loans to banks. But if this rate is higher, and then so the bank will reduce the borrowing from other bank or from the Fed. So that means the commercial bank, they have less resource they can use to make new loans. So that means their ability to generate new money supply will decrease. On the other hand, if the discount rate decrease, and then so the commercial bank can borrow cheaply, so they are going to borrow more from the Fed or from other commercial bank, and then they are going to have stronger ability to make new loans, so they are going to generate more money supply in the economy. So this discount rate. The other thing is the Fed can adjust the money supply is change the reserve ratio, right? So remember, so we talk about money multiplier. So the higher the reserve ratio, the lower the ability for commercial bank to generate new money supply, or the smaller the money multiplier, right? But in reality, so the Fed has stopped to adjusting discount rate or reserve ratio. So those two things pretty much keep constant over time. And then so they use open market operation by purchasing or selling treasury bill to adjust money supply. All right. Okay, so now we move to the next chapter and quickly talk about how the central bank can affect the aggregate demand by changing money supply, right? So here there are two things we need to understand, but the goal here is so how the monetary policy can affect the so how the monetary policy can affect aggregate demand. So by the way, so there's a question. So the Fed set the federal fund rate. Yes, the Fed set the fund rate, but recently the Fed usually don't change that rate. Okay. Right. So now let's go to this chapter again. So this is not going to cover in the exam, but so it's important to understand some key concepts, right? And so here there are a couple of things. The first thing, let's go to the part, is the money demand curve. So what is the money demand curve? So on the horizontal line is the quantity of money. So that's money demanded. On the vertical line is interest rate. So this just says the higher the interest rate, the lower money demand. The lower the lower the interest rate, the higher the money demand. But to understand that, so we need to understand the trade-off of holding cash, right? So what is the cost and what is the benefit? The cost of holding cash is the interest income you're going to forget, right? Because if you keep cash, and then so the cash is going to bring you zero interest rate. But if you deposit your cash in the bank, then you're going to earn some interest, which is here. Then the higher the interest rate, and then so the larger the cost. On the other hand, so keep cash, you have some benefit, right? And then particularly think about in a transaction, right? Or in the old days, right? So if the credit card is not available, or if the bank deposit so it's not accepted, right? You think about you go to some like small town, so they don't have these credit card readers. They don't know you. They don't want to take your personal check, and then so you must use your cash. And actually, so this cash brings you convenience, because cash is going to be widely accepted by everybody, right? So that's just how we define cash or how we define money. Okay, so that's a benefit. But certainly, so this interest rate is going to change the dynamics. Or the interest rate is going to determine how many cash you want to carry. So or in other words, so this interest rate is going to determine the money demand. Okay, to summarize, the higher the interest rate, the higher the cost of carrying cash, and then your demand is going to decrease. The lower the interest rate, the lower the cost of carrying cash, and then so the demand will increase. Right? So this is demand. Now, what is supply? The supply, let's go to that slide. Right, so and then so supply is coming from the central bank. So the central bank they are going to determine the money supply. And usually here we just assume so the money supply is independent of interest rate. Actually, interest rate is going to determine by the equilibrium, right? Or in other words, so this is supply, and demand supply is going to jointly determine the interest rate. for the Fed, if they want to adjust the interest rate, and then what they're going to do, so they're going to change the money supply, right? And the certainty, so if, let's go to there, right? So if the Fed want to see a lower interest rate, they are going to increase money supply. On the other hand, if they want to increase the interest rate, and then they are going to reduce the money supply. But now remember how the Fed can increase or decrease money supply. To decrease the money supply, they are going to sell treasury bill. To increase money supply, they are going to buy treasury bill, right? So in the open market. And then to put them together, so in the previous chapter, we learned how money supply is determined, how the Fed can affect money supply. Now in this chapter, we are going to bring the money supply together with money demand. And then you can see there's the interest rate. It's going to determine essentially by the action of the Fed. Now the last things I'm going to show you is, so once the Fed has alternate or has changed the interest rate, so that is going to have impact on aggregate demand. Okay, let's go to that slide, and then we're pretty much done. All right, so if the Fed increase money supply, remember how the Fed can increase money supply. They by purchasing, let's just say, buy T-bill, right? So by purchasing T-bills, they increase money supply. Now the more money supply is going to lower the interest rate. The interest rate reduce is going to make investment more attractive. Just think about your mortgage. Think about the business, take loans, right? So the investment is going to rise. Now the investment rise, this also is going to raise your income. And then that's going to ripple through the economy. It's going to lead to higher consumption spending, right? And so that just means, okay, so we are going to have aggregate demand curve shift to the right. But why this is important? Now let's just quickly draw a diagram to remind you what we learned in previous chapter. So we have supply, we have demand, we are in the long run equilibrium. Now there's a negative demand shock. So now we are here, right? Let's call this E1, this E2. And now we are in a recessionary gap. And in the previous chapter, we say, okay, so the fiscal policy can help. How the fiscal policy help? So we just increase G, decrease T, right? So that's going to lift up the aggregate demand. Now in this chapter, the monetary policy can also help. How monetary policy help? Exactly follow this logic, right? So that's going to lift up the aggregate demand. So this actually explains why in a recession, usually the Fed is going to reduce interest rate. But how they reduce interest rate? Literally, they through purchasing treasury bill, right? So actually, the opposite side is going to happen. So when we are in I saw there's another slide. Apologize. So, all right, so it's here. So let's just go to the previous slides. So this is when we increase money supply, right? This is going to lift up aggregate demand, right? And now again, so how we increase money, how the Fed can increase the money supply? So by T-bill. And then that's going to lower the interest rate, right? So then that's going to affect investment and affect consumption. So that's going to lift up aggregate demand. So usually this is a response to a recession. On the other hand, the Fed can decrease money supply. Again, so how the Fed can decrease money supply? They're gonna sell T-bill, right? And then by selling T-bill, so they decrease the money supply, then you're gonna see a higher interest rate. Higher interest rate, then so you're gonna see lower investment spending and lower consumption. And furthermore, that's going to move the aggregate demand to the left-hand side or reduce aggregate demand, right? So then usually this happens when we are in the expansion, so the Fed want to cool down the economy, right? So to summarize here, or to finish this part, so let's just show you, right? So show you here. So this is the Fed fund rate. Okay, so actually this Fed fund rate is red. The bank can borrow from the Fed. The red, the bank can borrow from each other. But again, so the Fed can change or can adjust this fund rate. But largely, so the way they affect this fund rate is by open market purchase. Through purchasing T-bill or sell T-bill. Okay, remember, so if the Fed purchases T-bill, so that is going to lead to increase in money supply. The money supply increase, that's going to lead to the interest rate to decrease. On the other hand, if the Fed sell treasury bill, that's going to lead to reduce in money supply, that's going to reduce increase or increase. Now let's look at what happened since 2004. Okay. So you can see, so the Fed target fund rate, or which is red, the Fed want to see in the market, steadily increase until here. And then suddenly in 2008, so this rate declined sharply. Now, why this rate declined sharply? This is just coincide with the financial crisis. The economy is in a deep recession, in a deep depression. The Fed want to stabilize the economy, right? So that's why. So they do their best to reduce the federal fund rate. But how they did that? By purchasing treasury bill. But then, so you may wonder what happens here. So this, we are reaching a 0% interest rate. So this is we call the zero lower bound. Because if you just put the interest rate below zero, and nobody want to hold cash, or I mean, so literally, so the bank, the financial system have hard time to digest a negative interest rate. If this is negative interest rate, then no one want to deposit in the bank, in theory, right? Okay, so I'm going to stop here for the discussion. And then let's just take a quick break, and then so we go to the next session, right?